Welcome to another episode of the Student Loan Planner Podcast. Today, I'm going to talk about something I haven't talked about in years at length, and that's because I haven't really needed to a whole lot, and that is paying off your student loans and student loan refinancing, and specifically a strategy within the student loan refinancing world called the student loan refi ladder. So I have literally not talked about a lot of strategies about how to pay down student loans, I feel like, since 2019 or even early 2020. And why have I not talked about it? Because it hasn't been in most people's best interest that have federal student loans for a few different reasons. So one of those reasons is, when you have 0% interest on federal student loans, literally anything is better with your capital than paying down your student loans. Why? Well, if you can take $10,000 and put it into 0% student loans, or you can put $10,000 and put it in a high yield savings account, if you are earning something greater than zero, you are earning arbitrage by putting all your money in cash and not towards your student loans. That is why I frequently see clients with six figures of cash just sitting in a bank account, because these are people in many cases who would have invested it, would have paid down some loans, but analysis paralysis struck, and they literally have just been piling up cash for years. And then suddenly the One Big Beautiful Bill Act came around and stripped a ton of protections from federal student loan borrowers. And the question now that I'm getting from a lot of people is, should I just opt out of all this mess? Should I stop listening to the Student Loan Planner podcast and just refinance my student loans and then start listening to Dave Ramsey and Susie Orman, right? LOL. I won't take it personally if you want to do that. But I do think that it's a little bit interesting to talk about some of these strategies when it comes to paying down student loans and who should consider it, who should absolutely not consider it, right? So I think that would be kind of an interesting controversial podcast episode today that I think I like to share with you. So, first off, let's talk about interest rates. So during the early pandemic, interest rates were ultra low. So people with Stafford loans had rates in the low fives and the low sixes for Grad Plus. That's not that bad. That's not terrible interest, right? As time went on, as we had really bad inflation in the economy and interest rates went up, in the latter part of the sort of pandemic era, the latter part of the Biden administration, interest rates were pretty high, and they got as high as Stafford loans being at 8% and Grad Plus being at like 9%, which is crazy high. So we have a big range of people with different interest rates, and then people that took out loans pre-pandemic are usually in the 6s and the 7s for interest. And why is that the case? It's because of how you borrow student loans in the first place. Every year there's a treasury auction that sets the 10-year treasury rate at a certain time, and then the Department of Education uses that particular treasury auction to benchmark the yield for Stafford loans and for Grad Plus and Parent Plus. And what they do is they say for Stafford loans, it's a margin of 3.6% above the Treasury 10-year rate. For Grad Plus and Parent Plus, it's 4.6% above the 10-year Treasury rate. So the 10-year Treasury rate auction was I think it was 4.4 or something recently. And then, you add 3.6 to that, and that's why you got to a Stafford loan interest rate of 8%. And then a Grad Plus interest rate plus 4.6, that yields basically 9%. And so that's how you ended up with Grad Plus at about 9%. Now, again, what happened was that people were mostly rational during the student loan pause, which is if you had federal student loans, you did not refinance them. You kept them as is, you got the 0%. Now, the thing I'll say is we were calling out during the student loan pause when there was rates available as low as 3% for 20 years fixed. We did call that out to a lot of people, and we said, hey, this might be, the low point of long-term interest rates, and maybe some people who even have 0% should consider locking this in long-term if you think that these are really attractive long-term rates. And some people did that, and those people that did that, I think for the most part, are pretty happy that they did that. There's even one lender in particular that I remember from back in the day that tried a 0% 6-month pause interest rate and then 3-something for 20-year fixed after those 6 months, and that went so well that lender literally went out of business. So I think that there's a lot of interesting things that happened during that student loan pause era with people that were worried about the interest and decided they just wanted to pay it back. Now, you had a group of people that I would say are like consumer advocate types of folks that really are trying to help borrowers, but they're also very strongly believing in, do not leave the federal system. It's a terrible idea to leave the safety of the federal system. And people really pounding the drumbeat of this, particularly in the first couple years of the Biden administration. And, in many ways, they were right with the Biden administration in charge that was, for most people, a big, big mistake to leave the safety of the federal system. But the One Big Beautiful Bill Act has really changed in the law a lot of things that people used to really enjoy and benefit from federal student loans. So the biggest thing that's happening, I believe, in 2027 is the forbearance protections that people have enjoyed for so long are pretty drastically changing. So it used to be that you could get 3 years worth of forbearance for a loan set before you would sort of lose out on any more forbearance that you could access. And then you could consolidate those loans and gain another 3 years of forbearance. So it's literally possible under the old rules you could get 6 years worth of forbearance on your loans if you knew how to game the rules. But the new law says starting I think around mid 2027, I think is when this kicks in. I have to double check. But the forbearance you're going to be able to access is just going to be 9 months of forbearance out of a 24-month period. That's very, very different, right? If you think about what that means, most private loans or a lot of private loans have forbearance periods available of a similar time frame, right? So that means effectively going forward, starting in a couple of years, there's not going to really be any meaningful difference between federal student loan forbearance and private student loan forbearance options. So you're going to be looking at fairly close to apples and apples. Now, of course, federal student loan forbearance could go back to what it was if you have a democratic unified control, but the new law makes that a lot harder, right? The law would have to be rewritten, not just a Department of Ed action, because the law is very clear about what Congress said, this new Congress, right? So, if you think about that forbearance policy, it is true, though, that the income-driven repayment is only available on federal student loans. But for that income-driven repayment, for anybody that's making six figures, that's not really that attractive, because it used to be that you got 10% of your income and it was discretionary income, meaning that you can write off or deduct 150% of the poverty line based on your family size. So 150% of the poverty line for your family size, let's say you have a family size of 4, let's say. So poverty line, this is just me guessing on the top of my head. Well, it's probably like 30K, 35K, something like that. And then total write-off might be like 40 to 50K before that you could earn before you pay 10% of anything. So what that works out to is the effective take on your student loans. In other words, what you're paying divided by your total income. It didn't work out to 10%. It really worked out more to like 6 or 7%. That was the effective rate. So think about marginal rates and effective rates. That's kind of like how student loans worked back in the day. You had this big deduction, then you paid 10%. And so it worked out to like 6 or 7% as an effective rate that you were losing to your student loans under the pay or the IBR plans. But the new rule with the RAP plan is 10% of AGI just straight up, $50 per month per child that you get to deduct. But other than that, it's just straight up 10% of AGI. That's actually a lot larger number. So the ability to avoid high payments as a six-figure borrower is going to be much more challenging. Now, if I was a resident or a fellow or, a five-figure income earner, then I would realize that the RAP plan allows, 1 to 10% of AGI if you're a five-figure income earner. But for people that are making six figures of income, there's very little protection in terms of what that income-driven repayment allows you to pay. So let's talk about paying down student loans. I've talked before in this podcast that folks with a debt amount that's lower than their income should consider paying off their loans. The only exception to that is people who are going for public service loan forgiveness. If you're going for public service loan forgiveness, a lot of times you probably, by the time you find this podcast, already have years worth of credit that you've built up towards that program. And then because they removed the requirement to have a partial financial hardship to access the IBR plan, that means that even somebody with a $300,000 income and a $100,000 student loan balance with a few years of credit towards PSLF could actually get loan forgiveness through the IBR plan and accessing capped payments on the standard 10-year repayment plan. So that means that, the only exception to that rule would be those people that are in that scenario. You should go for PSLF. But if you have, less debt than your income and you're in the private sector, you should pay off your loans and you should probably follow this refi ladder strategy that I'm going to tell you about in a second. Now, for the folks who have a greater than 2-to-1 debt-to-income ratio, unless there is some sort of major lifestyle reason that you want to be out of debt, or if there's some sort of strong, opinion that you and your spouse have together as a joint couple that you both jointly want to be out of debt, that is something that sometimes comes around, by the way, right? It is not uncommon for there to be one spouse that's very high income and one spouse that is reasonably high income, right? A big difference in household incomes. And by filing taxes separately and trying to go for forgiveness, that could be creating a large tax impact on the much higher income earning spouse, because the hit on married filing separately is usually, related to how big the difference is in two spouses' incomes, out in a regular state, like a New York common law state, Florida common law state, that kind of thing, right? And so in that scenario, the higher income spouse might literally want to encourage and help the lower income spouse pay off his or her loans, because they want to be debt free so that they can begin to tackle other things in their life that they would rather accomplish together, right? So things like starting a family or buying a house, or helping the lower income spouse, if the spouse wants to, be able to cut their hours at work if that's a desired goal. I very frequently hear from spouses or primary borrowers that I am working so much. I am so tired. I'm working 5 or 6 days a week. I really would love to be able to work 3 or 4 days a week just to have a little bit lighter schedule, especially with all the chaotic things going on in my life. And a lot of people feel like they have no choices in the matter, because they have to focus on, paying off their student loans, at least so they think, right? So that's not something that luckily you have to do. It's just an option. If you have a debt to income ratio greater than 2 to 1, that means that you can go for forgiveness if you want to. And you probably could pay off your loans if you really felt strongly about it, but you don't have to. Most people will be better off going for forgiveness if you're in that 2 to 1 debt to income ratio or above. Especially if you have access to the new IBR plan. So if you have access to pay, we know that's going away. But the new IBR plan, which is available to borrowers who took out their first student loan after July 2014, that is sticking around. And we know that if you have access to that it makes your path to forgiveness a lot easier. Now, if you are in this in-between stage, if you are in between, a 1-to-1 debt to income ratio and a 2-to-1 debt to income ratio. So for example, let's say you're a pharmacist with $100,000 of income, and your debt is between $100,000 and $200,000. That's what I mean by like a debt to income ratio between 1 and 2. You have choices, right? You have choices, and a lot of times these choices are dictated by, how much disposable income do you have? Now, obviously, somebody who's making $200,000 a year, who has a debt to income ratio 1 to 2, probably has more disposable income than somebody who's making $100,000 and has a debt to income ratio between 1 and 2. So it is kind of situationally dependent. But if you're in that middle kind of range, right, of the 100 to 200K debt, 1 to 2 times debt to income ratio, if you're going for public service loan forgiveness, that is the better choice. But if you are in the private sector, that's when it comes into play of, should I pay off my loans? Now, I will tell you this, even though maybe I don't know if it's in my interest or not to tell you to pay off your loans, but because you could argue, well, you have student loan refinancing links, and you also have a student loan consulting service and a tax business, which, is better for people being in debt. So I'm not really sure what my economic best interest is to tell you, but I like to talk about this out loud just so you think about conflicts of interest and any advice that I could give. But I mean, I tried to tell people what I think is best, and I try to tell people what I think I would do in similar circumstances, because that's how you have a business that people trust, is just you try to be honest, right? And so like I'm going to say, if it was me, unless I was going for public service loan forgiveness, I would not want to be in debt with a 1 to 2 debt to income ratio. I would not want the uncertainty. I would want to be done. I would want to move on, and I would probably be willing to live very frugally to get rid of the debt as fast as possible with a debt to income ratio between 1 and 2 if I was living in the private sector. Now, there's some exceptions. There's some big exceptions. What if you live in a really high cost of living area? What if you have several years of credit you've already built up? That happens all the time. I'm talking to somebody that has 5 to 7 years of credit towards a 20-year forgiveness plan. They only have 13 to 15 years left to go. Okay, like maybe we need to focus on just going for IBR anyway and getting forgiveness because you're so far into it already. And unless you're willing to make those lifestyle sacrifices, you're going to be in debt repayment for 15 years anyway. So why take it out of the forgiveness plan if you're not going to be making, extreme sacrifices to pay the debt off quickly, right? So I think it really does depend on your goals and your values, and those have to come first. Those have to come first before any, trite rules or, debt-free rants or anything emotionally that you hear that people tell you to do. Ignore it. Ignore it and focus on what are your life goals? What are your dreams? What do you want for your life? What are you willing to sacrifice? You have to be honest with yourself. Waiting, if you have a dream of having kids, it is not a good idea to wait until you're debt-free until your late 30s to have kids. I can promise you that. if only because you are so old in your 30s and so tired all the time and you have no energy. And I can tell you this from personal experience, LOL. It is hard being a parent at any age, and it's especially hard as you get older. My dad was in his 40s when he had me. I have no idea how he did it. Actually, I do. It was my mom. But, I think that it's really difficult to have kids at any age, and, and your energy levels decrease as you get older. So it's like you can't let the tail wag the dog. You can't let the tail of student debt wag the dog of your life goals and dreams, because it doesn't work out well when you do that. Now, on the flip side, if you are able to practice contentment, the old joke is like, a monk has enough because he's content with less. And that's the secret to the contentment, is just being happy with less. If you're able to live like a monk and that doesn't bother you and it doesn't bother your significant other, then that can be really helpful in paying down your debt really quickly. That can help you psychologically get through a period of sacrifice, knowing that there's a light at the end of the tunnel. The thing that is concerning is you don't want to put that light at the end of the tunnel, in my opinion, probably more than 5 years away, unless you have one of these 3% 20-year fixed interest rates that you're comfortable carrying the debt for the entire term length because of how good that is, right? So that comes to my point of the student loan refinancing ladder. If you are convinced that the right thing to do is to get rid of your student loans, here's a couple checkmark boxes for you. Do you have 6 months in your emergency fund? Do you have own occupation disability insurance in case you lost your job? Do you have term life insurance to protect your family in case something happened to you? Do you have the ability to easily get a new job if you lost your current job due to the economy? If you are checking all these boxes, here's another one. Do you have a modest housing and car payment relative to your income? What's modest? Well, are you saving money? Are you easily putting extra money away every month over and above your big fixed expenses into your bank account and saving? So so all those things are just an example of somebody who is financially in great shape and who has a protected downside financially, in terms of like, what if a bunch of bad things happen? Would this person still be able to make that debt payment? The answer would be yes. So if you check all those boxes and your debt to income ratio is below 2 to 1, you're in the private sector, and you're like, I'm done with this. I'm tired of listening to Travis on the Student Loan Planner podcast. Please give me true crime. Please give me Susie Orman, right? If that's how you're feeling, then that's okay. And then what you would do, in my opinion, is something called the Student Loan Refi Ladder. Now, let me explain how that works. The main reason for doing this is to protect the amount of cash you have to lose towards student loans every month on a required basis. So when you sign up for a student loan refi, you can choose a 5-year, a 7-year, a 10-year, or 15-year, or 20-year. Those are the typical term lengths. If you want to think about how much debt you have, think about how much debt you have in your head. Take, that amount of debt times 0.6%. That is roughly the 20-year fixed monthly payment that you'd have to pay on a 20-year fixed plan. So 0.6% on a $200K loan is about $1,200 a month. So that's roughly how you calculate what a 20-year fixed rate would be per month. Standard 10-year is about 1% of the balance. So on a $200K loan, it's about $2,000 a month. And to pay it off in a 5-year term, you're probably looking at, pick a number, it's about 2% of the balance. So 2% of 200K, it's about $4,000 a month. Now that's just a quick rule of thumb. It's not a very specific, exact number, but it's a great idea to know how much your payment would be if you committed to a 5, a 10, or a 20-year repayment plan. Now, let's say you are a dentist with $400,000 of student loans. Okay, let me show you why this strategy helps. If you start off with a refi of 10 years on a $400K loan, you would have a payment of $4,000 a month on a 10-year loan. What happens if you go try to qualify for a mortgage? Well, they're going to ask you what your back-end debt-to-income ratio is. They're only going to give you a loan if your back-end debt-to-income ratio, that means the total amount of your income going to debt payments, is below a certain number. For some doctor mortgage lenders, that number can be kind of high. I think it can be as high as like 50%. I forget the exact number, but it's like unusually high. For a lot of like conventional lenders, though, that limit is more like, I think it's 36 or something along those lines, right? So one of the reasons why you want to start with that longer term rate initially is because it gives you that lower back end debt to income ratio. So you can more easily qualify for a mortgage. If you want to start a practice or do a business loan to buy a practice, then it allows you to qualify for a practice loan more easily because you put yourself on a longer term, lower required payment situation. So the lenders are more comfortable lending to you because they're not fearing that you're not going to be able to afford to make all your other debt payments, right? So you start with a 20-year fixed rate. On our website, studentloanplanner.com/refi, REFI, right? So studentloanplanner.com/ Refi, R-E-F-I. If you go to that page, you're going to see what I believe are still the largest cash bonuses on the internet for student loan refinancing with all the major lenders. And so you'll see all the major national lenders with the biggest cash bonuses on that page. And what you could do is you could apply with one of them to get a 20-year fixed rate. And let's say you got a $400,000 loan, 0.6% of $400,000 is about $2,400 a month, and you start off with that $2,400 a month payment. And let's say you get a 5.5%, right? And let's say you've got a lot of extra money available. Let's say you have an extra $5,000 a month that you get at the end of every month. And let's say you decide to throw that at your loan, that extra $5,000 a month. So within the course of a couple years, you're paying not just $2,400 a month, but you're actually paying $7,400 a month. In total, that's what, off the top of my head, I guess it's like 90 grand, something like that. So let's say, factoring in interest of about 30K a year, your first year you pay it down to let's say 350-ish, and then you pay it down to like 300-ish after 2 years, right? With all these extra prepayments. So now here's the next rung down on the student loan refi ladder. So think about a ladder. If you're climbing down a ladder, you start at the top and you work your way down, right? So you start off with a 20-year fixed rate, and then you take your next step down the rung of the ladder. Now, for most people, that would just be a standard, or that would be a 10-year refi. So you would refinance that $300K. You could do it at studentloanplanner.com/refi and go apply to a different bank and get another cash bonus. That is not the main reason to refinance. That is just a extra benefit. Instead of an origination fee, it's like getting a reverse origination fee where you get paid instead of you having to pay. So you get this cash bonus. For most of them, it's about $1,000 for a 6-figure refi on our site. That's split up usually in the lender giving some and us giving some. And before you actually sign on the dotted line, all you have to do is email help@studentloanplanner.com and then just let them know, hey, I applied for a student loan refi through your site. What information do you need from me? We'll send you a bonus form to fill out information so we can match your loan with the loans that are showing up in our system. And that will, we'll be able to confirm, yes, we can see you in our system being credited to us. When you sign, let us know, and we'll pay out that bonus. So, that's the process of how we kind of help people get the max cash bonuses. But that's, again, not the main reason you do the student loan refi ladder. You go down to the 10-year amount, the 10-year debt payoff term length. And what you're doing is, remember, you've been in repayment for 2 years. So you refi, and then you go from, again, a 20-year fixed to a 10-year fixed. Your payment goes from $2,400 a month to $3,000 a month. Why? Because you re-amortize the loan with a lower principal balance. So you take $300K times 1%. Remember, that's the 10-year, approximate rule of thumb for how much you're paying every month. So that works out to about $3,000 a month. So your monthly required payment did not increase that much. It just went from $2,400 to $3,000 a month. And now you have 10 years left on your debt paydown plan instead of the original 20 you started with. So now let's say you continue making these very, very large payments of $3,000 a month plus the extra $5,000. So you're paying $8,000 a month on your loans. So if you do that, you pay close to $100,000. Your interest is about $20K or so at this point, maybe even 15. Let's say you get a 5% interest rate. So let's say that interest on $300K in this case is just $15K a year. So if you're paying about $90, $95, and you're paying $15K of interest, you have $80K going to your principal balance. So you're going to watch your $300K loan fall to like $220 in year 3, I guess, of the total repayment. And then in year 4, you're going to watch it go from $220 to, say, like $140. And so at this point, you could take your $140 and do the final step down the rung of the refi ladder, and you could refinance to a 5-year fixed. At that point, you are again resetting the payment, and you're going to take a $140K loan, you're going to refinance it, and you're going to have a payment of about $2,800 a month, because 2% of $140,000 is about $2,800 a month. So your required payment now, $2,800 a month, you are paying that amount, and you will pay, your same $2,800 a month plus $5K extra that you have that you're throwing under the loans. And so you're essentially going to be done at that point in about 1.5 years. So what we did is we created roughly a 5.5-year repayment schedule for getting out of debt. But what we did is we kept it at a required payment of around $2,000 something a month for the entire duration of the repayment. And why would you want to do this? Let's say there's a 2008 style event. Let's say the stock market crashes 50%. If that were to occur, you do not want to be obligated to be paying a 5-year fixed rate on a $400,000 loan. The 5-year fixed rate would be like $8,000 a month. Imagine having to have no choice but to pay $8,000 a month during a 2008 style event. At a minimum, you could take all that money you were paying down on your student loans and invest it and make a killing if you had a stock market crash of a 2008 level style, right? I mean, remember the stock market, I think, went down over 50% in that period. And if you're a healthcare professional or some other professional, you are probably one of the few people that will still be making an income, because if you look at unemployment rates for graduate and professional degree holders, they are fractional compared to everyone else in a bad economy, which means you have the power of still retaining an income. You want the flexibility for that income to go towards investing during a downturn and not towards your debt. So that's one reason. The other reason is becoming a business owner is one of the best things you can do financially for the most part if you're a healthcare professional in particular. So if you decide to go into business ownership, you do not want anything getting in the way of doing that. Specifically, you want to be able to get a practice loan to start your journey towards being a business owner and paying off that practice loan. You want that journey to start as quickly as possible, and you do not want a high required fixed payment getting in the way of that. Likewise, if you want to buy your dream house, you can get great terms with Dr. Mortgages and other conventional lenders. We have a Dr. Mortgage marketplace on our website at studentloanplanner.com that you can search if you're in the market for a house. And, you know, what these Dr. Mortgages do is they give you an interest rate that's comparable to a conventional mortgage, but gives you a low to no down payment. So you can use that money towards, you know, renovating your house, unexpected, you know, repairs, furnishing the house, you know, anything you need to do in terms of remodels. And also if you have a, you know, you can write off mortgage interest up to the $750K mortgage limit. And so if you're not taking full advantage of borrowing that full amount, that can also make that, you know, essentially you can make that tax deductible by taking more in the mortgage up to that limit. So there's all kinds of reasons why you would do, max out your mortgage for itemization. But that's actually, you know, not the main reason. The thing is the time to buy a house. You want to buy a house when you want to be able to buy a house. You don't want anything getting in the way of you being able to buy a house. And I had a very successful dentist reach out to me years ago before the pandemic who did a refi of a 7-year refi, very aggressive business owner, very high income, started a scratch practice that was doing $2 million of revenue within like a couple of years. I mean, he was a real hustler. And you know, he reached out to me and said, hey, you know, and he chose the 7-year, by the way. I didn't recommend it to him, but he chose that 7-year term on his student loan refinance. And he reached out to me and he says, hey, I'm having a lot of problems. He goes, I really need to refinance this at a higher interest rate to a 20-year fixed because my bank is telling me they won't give me a loan for what I need to do with my practice, and I need to be able to refinance this. Or maybe it was I can't remember if it was that or his mortgage. One of the two was giving him problems for being able to get debt approved, and he was able to get that approval, but only after he signed up for a higher interest rate to get the 20-year term to give him a lower required payment to make the back-end debt-to-income ratio work for his mortgage qualification or loan qualification. So that's a you know, a cautionary tale. I've also seen cases. I remember there was like a dental specialist years ago who I think was having some really tough situations with like finding affordable childcare. And I think that she was working like 3 days a week, also having a struggle finding, you know, competent childcare. This might have even been during the pandemic, right, when it was really, really difficult all around for everybody. And I think that her required payment, because she signed up for a 5-year fixed rate because that gave her the lowest interest rate. But the problem is her kids hit that like critical young toddler phase where they like are a little bit too young for preschool, but a little bit, you know, I don't know, needing really attentive, like nanny style care for her situation with all the inflexibility of her work schedule that she had. And she had like 12 or 13K a month going towards her loans because she signed up for the 5-year fixed rate and she like really regretted it. Right. So I think that you want to be careful with how much cash flow you're promising to your loans. That's why I like the student loan refi strategy. Refi ladder strategy. We've used it with clients for years. We used it a lot more in the late 2010s, back when people still had to pay their interest rates, right? Like back when interest rate wasn't zero. And, you know, again, that you only should do this if you're committing to paying down your loans. The majority of people listening to this podcast still need to be going for forgiveness. Why? Because new IBR is still a thing. Because pay is still a thing until it's not. Because PSLF is codified into law and that's not going anywhere. So if you're in that PSLF category, if you're in that IBR forgiveness in the private sector category, please feel free to ignore this. This doesn't apply to you. We do a lot of podcasts that do apply to you. Most of them will apply to you, but I think it's sometimes helpful to hear about the other options. And I think it's helpful to kind of either realize, oh, maybe I do need to pay down my loans, or maybe you hear this and you think, okay, I am glad that I'm on the same strategy that I have committed to long term, and this is just interesting information that I can learn and see what other people are doing with their loans and know that that's not for me, right? But I can maybe help somebody where it is. So if you know that you need to refinance your student loans and you're positive, you don't need to talk to us. You can just do it for free on our website. So you can go to studentloanplanner.com/refi, REFI. It's going to take you to the best cash bonuses out there, and you'll get, I think, an excellent deal in this particular interest rate environment. Why? It's because the credit risk is so low in the economy at the time I recorded this. That means that the extra yield that investors require on top of the treasury interest rates is very low. And what happens in an economic downturn is interest rates will sometimes decrease, but the risk amount extra that you have to get on top of what the government gets to borrow at, that widens out. And so, in a bad economic environment, you pretty much can't refinance at all because that extra yield that investors need to get to lend to risky borrowers is way higher, right? And I say risky borrowers as anybody besides the government. And so right now, interest rate, what we call credit spreads, are super tight. And that's why we're seeing people get really good rates. And I'll tell you that whoever is giving the best deal is honestly changing week to week. So you really do need to apply around to at least 3 places. And our marketplace on our website makes that pretty easy. You can do a pre-qualified rate check. It takes like 2 minutes, and you'll get an idea of if your rate could be lower. Anybody who's refinanced in the past 2 or 3 years also needs to do this just to see if there's anything better than what you currently have. For a lot of people, it is better. And also, I'll tell you this, some people could benefit from only refinancing part of their loans. This used to be a terrible strategy, but now that the SAVE plan is no more and it's going away and all these other options are going away, some people would be better off taking only their loans that are above, let's say, 7% and refinancing only those. Now, I think that that's not most people. Most people, if you refinance, you should refinance the whole thing, get it all in one loan, and be done, right? But for some people, remember I said, have these interest rates that are in like the low 5% range because you borrowed a bunch in the early 2020s when interest rates were ultra low. I probably wouldn't refinance anything that's federal that has like a low 5% rate. But, I think that it's up to you, right? I think that anything in the 6s or above, I would certainly feel comfortable refinancing if the debt to income ratio math worked out. If you are unsure about your strategy and you want to go through it with somebody that's done a lot of these, you could book a consult. So studentloanplanner.com/book. We'd be happy to talk about whether or not you should refinance and give you some guidance on that. In terms of conflicts of interest in this space, one thing to know is everybody earns money on student loan refinances. Anywhere on the internet you see a link, people are earning money on that. The difference is in the way I tried to construct Student Loan Planner from the very beginning when we started it, is my model was we're going to charge for consults, we're going to rebate a significant amount of the commission that we earn on refi to give us 2 different paths where we're incentivized for both paths. We, on a refi basis, we make money on that. On the student loan consult, we make money on that. If somebody does a consult and refis, technically we make money on both of those. But my goal was to minimize any conflicts of interest and not pay our planners based off of what path someone takes, right? The planner doesn't make anything different if somebody refinances or if somebody does forgiveness, which was an intentional design of incentives that I tried to do. I was economics and statistics as an undergrad major, and so they always teach you, everybody responds to incentives. So you need to have good incentives when you're having somebody give advice on this, right? And, what's interesting about the student loan refi market is in the fee-only fiduciary, like financial planning space, if you earn anything from anything, you're considered not fee-only anymore. But in the case of student loan refinancings, I can get a better deal by rebating some of our commission to somebody who applies than if they apply directly. So the way I look at it is sort of like I always try to do what's in the best interest of the person. And rather than wanting to be pure for a label's sake, if that makes sense, right? So that's the way I thought through carefully on how I designed this model, just because it's like, well, okay, if I can get a better deal with a big lender, if somebody applies through our website than if they applied on their own, why wouldn't I do that? And then I have to manage the conflicts of interest among the people that give advice to make sure that it's the best advice. So that's the way I've tried to run Student Loan Planner since I started it 10 years ago. and hopefully you can tell the difference between our site and others. There's a lot of places out there, for example, that will give you a free student loan meeting, and they only earn money if you refinance. Well, what do you think they're telling people, right? I mean, you have to have realistic expectations as to what people's conflicts of interest are. If something's free, you're the product, right? So if you need to refinance, if you know you need to, and now is a good time to do it, I'm being honest and transparent about that. If the math again overall makes sense, where your debt to income ratio is in a good spot, you have the emergency fund, you have the economic security in your job, right? You have the disability insurance. If you've got all those things, go to studentloanplanner.com/refi and apply around, and then reach out to our team and let us know what rates you're getting to make sure that you're getting credited so we can give you a cash bonus. And that's if you need to go for a refi. If you don't, obviously continue listening to the podcast, or if you need a follow-up or a refresh on your consult or a new consult, studentloanplanner.com/book. Thank you for listening to the Student Loan Planner podcast. Have a wonderful rest of your week. Are you on the free Student Loan Planner email list? If yes, you could upgrade your experience and discover student loan loopholes so good they might get repealed if I talk about them publicly. Find out my very best thought leadership that I really just can't be super open about anymore, unfortunately. If you want to get our very best tips, not just the ones that I can share for free, then go to studentloanplanner.com/insider to get a special discount for your year membership. That's studentloanplanner.com/insider and get our very best dozens of bonus content and tips that's going to save you money and get you out of student debt faster. And if you're already an SLP insider, please reply back to those emails and let me know how I can make it even more valuable.